Okay, good afternoon, everybody, and welcome to today's webinar, How to Use a Self-Directed IRA to Invest in Medical Office Buildings. My name is Erica Figueredo. I am the marketing specialist here at Next Generation, and we have an exciting presentation for you guys today. But before we get into all of that, I wanted to review some housekeeping items, introduce you to our speakers, and tell you a bit about Next Generation. So as always, today's session is being recorded and will be available for on-demand viewing for anybody that didn't get a chance to make it live. So if you are here with us live, welcome, and you will be muted for the entirety of the session, but that doesn't mean that we don't want to hear from you. So take some time to introduce yourselves in the chat box and feel free to use that feature to engage amongst yourselves as we go through today's conversation. So if you have any questions, you can either ask them within the chat feature or you can use the Q&A tab. We'll try to get to any questions that come up throughout the webinar if they're relevant. Otherwise, we are going to hold them off for the end. So to introduce our speakers, first off, we have one of our co-hosts, Peter Tzelios. He is the principal of White Capital and a co-founder, and until May of 2016 was the chief operating officer of Silver Peak Real Estate Finance LLC, also known as SPREF. SPREF is a privately owned national commercial real estate lender backed by Elliott Management Corp., a $28 billion fund. Prior to SPREF, he co-founded Full Stack Capital LLC and White Capital LLC in order to make investments in real estate related assets. In addition, FSC established and operated an outsourced CMBS originations and underwriting platform with Barclays Bank. Peter was previously a managing director and deputy general manager of the U.S. business of Eurohypo AG, which at the time was the leading international specialist bank focused on real estate and public finance. Prior to joining Eurohypo, he was a member of GE Capital Real Estate's specialized REIT financing practice. Prior to that, he practiced law in the real estate group of Thatcher, Profit, and Wood. He has a BS in finance from Fordham University and a JD from New York University School of Law. Peter is a member of the Bar of the State of New York and State of Connecticut, and he is also a member of the Executive Advisory Council of the Fordham University Real Estate Institute. Our second co-host, Henry Allen, is co-founder and managing member of White Capital. Henry was a director at Madison Capital, a New York City-based real estate investment company with approximately $2 billion in assets under management from 2012 through January 2015. Prior to Madison Capital and co-founding White, Henry was an associate director at Barclays Capital in the bank's real estate finance group. Prior to joining Barclays, Henry was a vice president at Eurohypo AG, where he worked with Peter and originated a broad range of real estate debt products. Prior to joining Eurohypo, Henry was an associate at GE Capital Real Estate, where he also worked with Peter, and prior to that, an analyst at CB Richard Ellis. Henry has a BS in economics from Tulane University and an MS in real estate development from Columbia University. Henry is also a licensed real estate salesperson in New Jersey. And of course, certainly, and last but not least, we have our business development representative, Scott Ritchie, who will be representing Next Generation today. Scott brings a wealth of experience to his role with the sales and marketing team at Next Generation, where he focuses on business development for the company. He has more than 10 years of experience in the sales arena, including 7 years in financial services, where he worked extensively with both group and individual retirement plan accounts. Scott has also worked in operations as well as marketing, media, and public relations, all of which serve him well and bring diverse perspectives to his current role with Next Generation. Scott is a graduate of the University of North Carolina, Wilmington, where he earned a BA in English and also earned a film and video production certificate from New York University. In 2007, he received his Life Underwriter Training Council Fellow, also known as LUTCF, designation from the American College of Financial Services in Bryn Mawr, Pennsylvania. Scott, who is married and has 2 sons, resides in Somerset County. So now to talk about next generation. Just going to share my screen really quick. So about next generation. So next generation is a custodian and administrator for self-directed retirement plans. So these types of plans are exactly like the ones you'd find at a brokerage like Fidelity or Charles Schwab. However, instead of investing in assets that are publicly traded, such as stocks, bonds, mutual funds, self-directed IRAs allow you to invest in non-publicly traded alternative assets. So our administrative firm and headquarters, Next Generation Services, is located in Roseland, New Jersey, and provides the record keeping and tax reporting services for all of our client accounts. In addition, we provide the educational content you'll see on all of our webinars, like the one that you're on today, as well as complimentary access to our knowledgeable representatives and other educational content, such as our white papers and blog subscription, which you can find on our website. Next Generation Trust Company, located and chartered in Sioux Falls, South Dakota, provides the custodial services for the assets held within our client accounts. So moving on to our very necessary disclaimer on what we don't do. Next Generation is not a bank or fiduciary. We do not provide any financial, legal, or tax advice. So any information provided in today's webinar is for educational purposes only. And as always, we encourage you to consult with your trusted financial professionals to determine if this strategy or investment is the right fit for you and your retirement goals. So with that being said, I am going to hand the floor over to our moderator, Scott Ritchie, who will drive today's conversation. So Scott, take it away.
Thank you very much, Erica. And thank you to Peter and Henry for joining us today. So I guess we should just dive right into the presentation. What is a medical office building? If you would like to elaborate a little on that for us.
Right. Well, thanks everybody for joining, and Erica and Scott for arranging this. We appreciate that. So medical office looks very much like a typical office building from the outside, but they are in fact very different from the inside, and in terms of the bones, in terms of their usage, in terms of the tenancy. And to get into that a little bit, I mean, from a physical standpoint, they're very different in terms of the layout. So you have, you know, much smaller rooms, exam rooms, bigger waiting rooms, different flow for patients to get in and out. Obviously, everything being built to ADA standards, American with Disabilities Act standards, and accessibility standards. Elevators have to be bigger, electric loads have to be higher, plumbing in all of the exam rooms, so you have a lot more infrastructure in terms of those things. Parking requirements are higher for medical office buildings. Tenants, some tenants need emergency backup generators. So you have a whole host of infrastructure that's much more expensive and much more intense from the construction side, as well as even from the tenant side. So then you have tenant build outs that are very, very different than just the typical office build out, where you have surgery centers that require, again, you know, they may require gas through the walls that has to come in for the anesthesia. Lighting, redundancy systems, and things of that nature. You have kidney dialysis centers that use a tremendous amount of energy and water. So you have a high investment by the tenancy itself as well, which then translates into sort of, and there you see sort of a surgery center, and you see what that looks like. It's a much different build out, obviously, than a typical office. And then that translates into sort of the tenancy itself, which, you know, at least on the assets that we focus on, we tend to try and focus on high intensity users, whether it's imaging centers, whether it's oncology centers, whether it's dialysis centers, where we have an anchor tenant that has that high degree of investment, and also comes with a high degree of stability. These tenants tend to perform very, very well, and we'll talk a little bit about later on in terms of the performance during COVID. But I think overall, that's sort of a high level of a little bit of how medical office differs from a traditional office building. I don't know if you have anything to add, Henry.
I'd say that typical suburban medical office building, which is what we focus on. We primarily focus on off-campus suburban office buildings, medical office buildings. They range from about 20,000 square feet to 50,000 square feet. They're generally 1 to 3 stories. They're all purpose-built, meaning that they weren't speculatively built. They were built for a tenant, whether it's a surgery center, as Peter said, or an imaging center or a dialysis center. And then generally they'll have practices that are complementary to that anchor tenant. So for example, if we have an orthopedic surgery center, we'll have an orthopedic group or physical therapy or occupational health in the building that cross-pollinate with that anchor tenant. But the buildings are, once you get inside, they are unique. So the hallways are much wider, so they can accommodate stretchers. The elevators are much bigger. Sometimes the air conditioning units are very robust, especially for a surgery center that has to have very clean air. So that all translates into a very expensive building compared to a traditional suburban office building. And so they might look the same, but they're very different.
And that also translates into the tenancy, where the tenancy tend to stay in those buildings once they're there, because they have a building that has the required infrastructure in terms of all the things we just mentioned: electric loads, parking ratios, plumbing, HVAC standards, and so on and so forth, that is in the building and in the walls. And they also have a high degree of investment themselves in the space in terms of surgical center equipment or kidney dialysis equipment or imaging equipment that becomes very expensive to move or to replace.
Yeah, in some cases you can't move it. For example, like a linear accelerator is housed within a concrete vault, and those vaults have, I think they're a couple of yards thick, these walls.
So you have tenancy that tends to, unlike traditional office, you have a tenancy that tends to be what we call sticky, or tends to want to remain in their space and renew once their terms expire. So it makes for a much more stable cash flow and investment.
Okay. Well, you described the characteristics of medical office buildings, and actually you would, I guess, touched a little bit on the tenant retention. With the infrastructure and how you can, certain things that would, I guess, be productive for those office buildings. With higher vacancies, can suburban office buildings be repurposed into medical office buildings? And would that create any kind of competition for what it is, you're looking to do?
Yeah, so obviously we're always looking at the markets that we're looking to invest in, and looking at not just the sub-market of medical office, but we also look at what else is out there in terms of suburban office or in terms of retail. There is a push for certain medical tenancies to want to be located in former retail centers or in existing retail centers, and that's always something that we look at. However, what we have found and what we've experienced and what we see is that converting a standard office building into a medical office building is a very, very expensive proposition. And we've seen that there have been some, no doubt, that have been successful, but we've seen that a lot more turn into a problematic asset for a number of reasons. Again, the layouts are very different, the infrastructure is very different, and that becomes very expensive to try and do a conversion, as opposed to, as Henry said previously, a purpose-built building that's originally built for medical. The other aspect of it is if you have a building that, let's say, has 50% vacancy and 50% is traditional office, so law firm, wealth management firm, or whatnot, they tend not to want to be co-located with medical tenants. They don't want to be around, people who are, maybe sick, maybe contagious. They tend not to want to have a law practice or a wealth management practice or whatever, an insurance practice or whatever office you might have, where there are gurneys and ambulances and things pulling up all the time, and the parking requirements are much higher and usage. So what you wind up, and what we've seen happen, is you wind up with sort of a building that has a little bit of both, but is really not successful in either, and that also becomes a problem asset. I don't know if you.
Well, I also think that owners of office assets and owners of retail assets aren't used to or accustomed to dealing with the high tenant improvement allowances that medical tenants typically demand. So to build out a tenant space, you're talking about hundreds of dollars per square foot. Often the landlord's contributing something like $75 to $100 a square foot for a high quality medical tenant. And that's unheard of in office and retail. You just don't give those kinds of TIs. So in order for somebody to convert raw retail space, for example, into a high acuity use, they're going to have to sign a very long-term lease, and it just doesn't give them a whole lot of competitive negotiating power in the marketplace versus having a purpose-built asset like we have, where we can, where we have all the infrastructure already there, and we can offer better terms for a tenant. So it's not as easy as it sounds to convert basic retail and basic office into medical space. Certain uses it does work for, like urgent care. That's a perfect example of something that's successful in retail environments. And maybe some like lesser acuity, like pediatrics, dental. You'll see that relatively successful in retail. Sometimes it's tucked behind the retail, so it's not really side by side with their prime retail tenants.
Okay. Now, you just talked about it. So could you kind of, I guess, compare or differentiate the medical office building with other commercial real estate classes?
Sure. So I'll just start off by saying what is appealing about medical office buildings is they deliver a stable dividend, a stable cash flow, and they appreciate over the long term. That's really what MOB differentiates from the rest of the assets. And why they deliver a stable return is the triple net lease structure, number one. So the triple net lease structure is we're insulated from increasing operating expenses. The operating expenses are really paid for by the tenants. So if we have a big increase in real estate taxes, or we have a big increase in snow, or some other expense, that's paid for by the tenants. We collect the base rent, so it's a stable cash flow. As opposed to other asset types, for example, let's say multifamily, you're really, as an owner, you are exposed to increases in operating expenses. Also, what Peter mentioned was the stickiness of the tenant. Because of the stickiness of the tenant and the long-term lease nature of these tenants, generally their leases range from 5 to 15 years. That stable cash flow is delivered. Other asset types, Peter, you can also chime in here, but other asset types, for example, I'd say like hotels, which is a night-to-night lease, are really susceptible to fluctuations. You're either crushing it or you're not crushing it. It's not a stable cash flow like MOB. Office is exposed to really prolonged vacancies. So suburban office buildings, sometimes you can have a vacant space for 5 years, and there's just not the demand there to fill it. And then, an asset class that has performed very well recently is industrial. Industrial has been super high in demand because of the e-commerce. And I would say that MOB is different from it because it doesn't cost a whole lot to build industrial buildings. The barriers to entry are fairly low, whereas MOB, you can see it, new supply for MOB just doesn't come on market or online that often. It's a very supply constrained asset type.
Okay.
Yeah, so I think the other thing that's different with some of the asset classes, hotels, and to some extent,
to a large extent, multifamily, which multifamily, you have sort of these short-term leases, you have move-ins and move-outs, you have a population that's there 24/7. So you have as with hotels and hospitality, you have a very highly intensive management business. And while from a medical office perspective, as owners, you obviously have to maintain your property very well and manage it well, and have your relationships with your tenants. From an operating business standpoint, it's much, or from a management, day-to-day management intensive standpoint, it's a much less intensive business than, say, a multifamily or a hotel is in that sense as well. So it's, again, we like it for the stability, for the tenancy, and for the continuous sort of returns that it provides.
Okay. So, I mean, those three are really strong points. Anything else why a person would want to invest in a medical office building?
Well, yeah, the most important aspect of our investment thesis is demographics. So we've got demographics on our side in the sense that the United States is experiencing an aging population. You can see from this chart that's up that the forecast is for increase in aging population. With an increased aging population, for example, if you're 40 years old, you might go to the doctor twice a year. If you're 60 years old, you might go to the doctor 4 times a year. If you're 80 years old, you might go to the doctor 8 times a year. So as you get older, you start going to the doctor a lot more is the simple way of looking at it, and spending a lot more on healthcare. So demand for our product, demand for the services that our product houses are going to go up.
so yeah, so I think, one of the statistics is that you spend over 60% of your
Lifetime healthcare expenditure for an individual is spent from age 65 and on. So when you see an aging population, as we see here in the slide, and as just some other numbers that we have here, I think like from 2010 to 2030, the population above 65 in the U.S. is going from 40 million to 72 million. In that same period, the population from 85 and older is going from 5.7 to 8.7 million. So there are just some statistics about the aging population. And as I said before, the healthcare expenditure is such that 60% of a person's lifetime healthcare expenditure is going to be spent after age 65. The number of visits, I think we have another slide, and I'm sorry, I don't know how to control this, but I think there's a slide there that shows the office visits with age, which is what Henry was speaking to. So if you're under 40 years old, you're going to the doctor twice a year. If you're 65 to 74, you're going 6 times a year on average. And then over 75, you see the number of visits there. So with an aging population, the demographics are very much in favor of more medical office. That coupled with a push towards broader healthcare coverage, and to some extent, there's a push, whether we get there or not, for universal healthcare coverage. But whether we get there to universal sort of government coverage or not, we're certainly getting to a broader push to healthcare coverage, period. And that, started with Obamacare, I think brought on 30 million people under, that were not previously insured into the insured market. And that's just continuing to be a push. So what you have an aging population with an insured population, the demand for healthcare is continuing to grow. And that's obviously a major theme that I'm sure everybody sort of sees in the news from time to time. And so that bodes very well for a medical office as well.
Okay. Sure. I mean, that Medicare issue, it's very interesting which way that goes. I would want to know if, from a market statistics dynamic perspective, can you discuss how you'd view acquisitions today when cap rates have compressed versus when you started acquiring the medical office buildings?
So I think what's
good about our model because we're really pursuing stable cash flow. We're not really buying something with the expectation of selling it 2 years from now and making a 20 IRR or a 50 IRR. I mean, that'd be amazing, but that's not our goal. Our goal is to deliver a stable cash flow. So with that thesis or that investment philosophy, we can execute in all markets, whether the cap rates were 6% or whether the cap rates are 5% or their cap rates are 8%. It's really sort of also dictated by the capital markets and at what rate you can lend at. So, in 2013, interest rates were 5% on MOBs. Today, interest rates are 3% on MOBs. But our cash on cash, our after debt service cash yield is relatively the same. So, yeah, cap rates have compressed, but we're still able to execute. We bought an office building in last October, and we bought one in May of this year.
So I think the cap rates were higher, but also as Henry said, interest rates were higher. But also 10 or so years ago when we started investing, or over 10 years ago when we started investing in medical office, medical office was viewed very much not as a separate asset class. It was viewed as suburban office, just another suburban office building. I think we recognized, and then after that, we saw other people start to recognize that medical office was actually a different animal. It was a separate asset class. It was not suburban office for all the reasons that we just discussed, whether it's the tenancy, the infrastructure, the credit of the tenancy, which we'll talk about a little bit. So with that, you started to see cap rates compress, which means prices go up, right? Cap rates go down, prices go up. So while we're buying at higher valuations today, we still feel that because of this, our investment thesis of having a stable performing asset class with continued appreciation is what we see, given what we just talked about in terms of demographic and demand for medical services. We still think there's room for growth. And also the benefit is that there is much more liquidity now than there used to be. While in the past it was viewed as suburban office, just another suburban office building, the demand was a lot less. Now what you have is a lot more demand from all kinds of investors, really. Institutional investors have jumped into the game in a big way. So while you're paying higher a little bit going in, you also have a lot more demand and liquidity when it's time to exit the investment, which you didn't have previously. So it's a little bit of a double-edged sword, but we think overall it's a net positive.
Okay. So what would you say some recent trends or headlines that might be affecting medical office buildings? What do you see out there? What are you hearing?
Yeah, so tenant consolidation is one of the things that, people, if you recall, in the past, were probably going to their doctor, and their doctor's office was probably a practice of 5 or 6 partners, physicians, maybe 2 or 3 partners, physicians. As I'm sure people are recognizing, you drive down the major corridors and you see the branding going on from every major medical system that's been buying up practices. So what you're having is the independent practices are being bought up and are going away, and new doctors coming into the practice are actually coming in as employees. As a matter of fact, there was a recent report came out, it was sort of a milestone that or for the first time rather, there are more physicians now, I think it was like 50.2%, that are employees of systems and physicians networks, hospital systems, and so on, than are independent practitioners. So that's sort of was a milestone, and that's obviously where the trend has been. So that's a little bit of a double-edged sword. You have the independent practices that are getting bought up by these major systems, and it's good from a landlord's perspective in that you are getting certainly an uptick in credit. If your tenant is Penn Health or NYU Langone or pick any other major medical system, you obviously have a very secure credit for a tenant that's going to be paying that lease pretty much no matter what, as we'll talk about, as we've experienced through COVID. We had a very, very, as a matter of fact, we didn't have any losses of rent during COVID in our portfolio.
Wow.
So So that's obviously a benefit. The double-edged sword is that now you're dealing with a major institution that has professional real estate groups with professionals, real estate professionals, and there's more negotiation, there's more leverage on behalf of the tenant, obviously. But that turns into, are you providing a good product? Do you have a well-located product? Are you providing good management, good services? Do you have a good relationship with and a good reputation in the market? In that these tenants want to be with you. They want to be your tenant. They want to be a partner with you in these assets. I don't know if you have anything on that front.
Yeah, the other trend that we've seen, and it's not a recent trend, this has been probably happening for the last decade or more, is a shift from on-campus to off-campus. So when we started looking at medical office buildings, the real prize was the on-campus MOB, the medical office building that would be attached to the hospital that you would walk across via a sky bridge or something like that. And I believe that has shifted. I believe that off-campus, located fairly close to the hospital, but off-campus medical office buildings are probably performing better than on-campus. On-campus medical office buildings have certain restrictions, like the hospital restricts who you can lease the space to. Sometimes they're on-ground leases. They're just not as clean ownership as an off-campus MOB. And off-campus MOBs offer a cleaner, healthier environment for people to get treated, especially if you're going in for same-day surgery procedure or imaging. It's just easier, more convenient, and safer for people to get treated in an off-campus environment than an on-campus environment. And I believe it also saves the hospital money, saves everybody money by treating them off-campus than on-campus.
Yeah, I think there's generally a lower cost structure off campus for a number of reasons. I think the push is for these systems to push the lower acuity services, same-day surgeries,
imaging, as Henry said, things of that nature, infusions, dialysis, to off campus into the communities where it's more convenient for the patients to get there, number one, and then keep sort of infection rates when you get into the higher acuity of the campus settings, so that you sort of avoid sort of the potential for that to occur as well, and then to sort of have a hub and spoke system where you draw the high acuity surgeries or hospital stays into the on campus, but otherwise push it out into the communities where it's cheaper for the hospital systems or the physicians networks to run, but it's also more convenient for the patients, right? Having more smaller locations in communities is more convenient for the patients to get there, especially the elderly, where it's closer to their home than having to travel 20, 30, 40 minutes to get to the campus, the hospital campus. So that's certainly been one of the trends, which bodes well for what we focus on, which again is off-campus medical office buildings.
Actually, real quick, when you were speaking, I believe you said that during COVID, you didn't see a negative impact on your returns. Is that correct?
Yeah, we actually were very fortunate. We did not experience any rent loss during COVID in our portfolio. And, we had an active dialogue with our tenants, but most of our tenants are major systems, major practices, major physicians networks. There are some smaller tenants that we had that were more impacted. So a dental practice where dentists were closed down, ophthalmologists were closed down for a brief period, or optometrists were closed down for a brief period, whereas most of the other practices remained open because they were considered emergency services. So they remained open and continued to pay rent. And even those that were much reduced in terms of their patients or their patient visits, again, if your tenant is a Penn Health or a Hackensack Meridian or a NYU Langone, those obviously tenants kept paying their rents and kept performing. So we were very fortunate in that regard. The other thing that we see is post-COVID is all of our tenants are reporting that they've recovered tremendously with pent-up demand for imaging services, pent-up demand for regular, just internal, general practitioner visits, pent-up demand for dentist visits, pent-up demand for all sorts of
Same-day surgeries.
same-day surgeries, orthopedic surgeries, things of that nature that were being put off during COVID. So the recovery has been extremely robust it's been reported to us from all of our tenants.
Yeah, that's great. I actually had a knee replacement surgery scheduled pre-COVID that got delayed, and then once in New Jersey they permitted the surgery, I was able to go in and get it. So, and that was it's coming up on a year now. So back in June of 2020.
Right.
So I was able to get that done. I just wanted to, the one thing I did want to address with COVID towards the end, obviously a lot of the physicians were utilizing the telehealth during COVID. Would the telehealth have any sort of decrease in demand for medical office buildings?
Yeah, well, telehealth is sort of one of those, you can look at it different ways. We view it as a net positive. Telehealth was occurring before COVID. Obviously, COVID accelerated it tremendously. And one of the reasons why was telehealth was not being covered by insurance and Medicare, or was covered with vastly reduced rates pre-COVID, and then during COVID, that was sort of the expansion under the coverage. So telehealth obviously got accelerated through COVID, but it was coming anyway. We view it as a net positive because telehealth, we feel, is going to drive more demand for medical office and for medical services, or it will drive demand for medical services, which then drives obviously demand for medical office. In that, telehealth is very convenient and it's very practical for certain things. An initial screening, an initial visit, an initial diagnosis that then needs to be either treated or more particularly diagnosed if it can't be diagnosed via telehealth. So whereas people might feel a symptom and not want to make a doctor's appointment and go to the doctor because it takes a long time, you have to wait a couple of weeks, things are going on, you don't have time in your schedule. Telehealth has made it convenient whereby people can get on the phone, do an initial screening, and that usually results from what we're hearing and experiencing through our tenancies is more visits. So you'll do an initial screening and the doctor say, well, I need you to come in now because I need to treat that, or I need to see it, or I need to see you in person before I can prescribe something, or you need a test, so you'll get a test. So telehealth, we think overall is going to drive the need for more visits, which then will drive the need for more medical office. And in addition, anybody who's providing telehealth as a practitioner needs a place to provide telehealth from. Most doctors are not going to be providing telehealth from their kitchen or from their whatever. They're going to be providing it from their office while they're treating patients in person. They'll go take a telehealth visit somewhere, which means they probably need a space that's specifically designed for that, with the right cameras, the right audio visual setup. So it might change the configuration of medical office, but we think it's actually going to result in the need for more space and more visits. I don't know if you have anything to add to that, but that's sort of our view of telehealth, or my view.
Yeah, I mean, while it has been around, there was a lot of discussion about it before COVID. As Peter said, it really took off. We'll see how it performs going forward, but we think it's a positive overall. I've used it. I like it.
Yeah, I see the benefit in it. It's amazing because you don't have to leave your house or your office.
But eventually you do if you need treatment.
All right. Well, listen, I appreciate the insight on the background on the medical office building as an investment. If you have any questions for me, I'd love to field them for you.
Yeah. So obviously, NextGen is in the providing services for self-directed IRA. So I guess the first question is what is a self-directed IRA?
Well, a self-directed IRA is just it's a type of retirement plan. It's the thing that makes it a little different is the account holder chooses the investments that get made. So they're familiar with the investments, but they're directing someone else to do it, usually a custodian like Next Generation. So instead of going to a traditional wirehouse, someone like Next Generation, a custodian, makes the investments on behalf of the individual.
And so what are the benefits, or why someone who's investing in real estate, let's say with us in medical office, why would they do it through an IRA account?
You know, because it gives you an opportunity to invest in what I call the alternative universe. It allows you to invest in investment vehicles that are not in Main Street or Wall Street, stocks, bonds, mutual funds, ETFs. You can invest in things like medical office buildings, private real estate investment trusts, private equity, things like that. So you just have a broader universe of things to invest in. So it can just kind of help your portfolio. It just can kind of expand it for them.
Are there any tax advantages?
You know what, the tax advantages are very similar, you know, because it has all the same basic tax advantages of your traditional IRAs. You know, a lot of people seem to think if you self-direct, it's completely different, but it has all the same characteristics of a traditional IRA. It's pre-tax, the money will grow tax deferred, and there'll be nothing taxable until you go to distribution. There are Roth IRAs available too, so you can do an after-tax investment using a self-directed IRA. It's another permissible investment.
Are there restrictions in the types of investments?
Yes. Well, in our world, what you want to avoid is what's called the prohibited transaction. There's three types of prohibited transactions. There's a per se prohibited transaction, self-dealing prohibited transaction, and extensive credit. All those transactions, they are prohibited. You don't want to engage in a prohibited transaction. They all involve dealing with disqualified people. Disqualified person is, you know, someone who benefits directly from the investment. There are rules and regulations that guard against them. A simple explanation of disqualified people, and it does go into greater detail, but they have what we call ascendants, descendants. You can't do business with your parents, your grandparents, your children. If you own 50% of a business, you can't invest in your business. There's actually a lot of rules and regulations, and our role as custodian is just to review them with our applicants and go over them before they open the account so they can be aware of what it is they can and can't do.
And what is the process and timeline if somebody is interested in doing something like this?
Well, we generally go with a 6 to 8 week timeline when we are working with someone who wants to open an account with us. 6 to 8 weeks is generally on the longer side. The process starts with opening an account. That's the most basic part. You submit an application. It takes a day or two to get approved. Once it's approved, we hand it off to our transaction team. So our office has two teams. We have a sales and marketing team and a transaction team. When the account gets approved, we'll do what we call a handoff to our transaction team. And then our transaction team will work with the new client in getting the account funded and then making the investment. The 6 to 8 week time kind of reflects the variable of the other custodian. So if the money's coming in from another wirehouse like a Schwab, E-Trade, Fidelity, that's out of our control. Like, we can't control how quickly that money can come. So that usually provides the largest lag on the process. And once that money is in and the account is funded, then our transaction team would work with the individual to make the investment. You know, and then they review certain documents like a certificate of good standing and things like that to make sure that everything's in line before the investment gets made.
Is there a lot of paperwork associated with the account?
Well, actually, you know what? A lot of what we do these days is DocuSign. I'm sure you're familiar with DocuSign. That helps to expedite the process somewhat because it's electronic. We do allow for, you know, paper. Certain applications, certain accounts might not have the option for DocuSign because there's a lot of documentation needed. An example is like an outsourced qualified plan where you're taking money from an existing 401k and you're investing with us. You know, that because that has a lot of paperwork, it's generally not advisable to do through DocuSign because it would just really complicate things. So, but a basic, like a traditional IRA, a SEP IRA, any of the other products we offer that can be done through DocuSign, that's the most expeditious way to kind of move forward.
All right, thank you.
Great.
Great.
Here is just this slide that's up to kind of reviews that timeline that I had discussed. The 1 to 6 weeks is that, if people come, unfortunately, the very first thing that needs to happen is the account does need to get open. So nothing can happen until the account is open. So when people are interested in opening an account, a lot of times we like to do what we call an education session to kind of give them a background of everything about the self-directed IRA, including the setup process and timeline. So this way we can properly manage their expectations, because a lot of times, especially with real estate, they cannot sign any paperwork until their account is open, because it's not them opening an account, it's their IRA opening accounts for the benefit of John Doe. So it's important, like for instance, if someone was going to invest with your company in a medical office building, their first step would be to call us and get the account open before they can sign any paperwork, to make a purchase with you. So it's important to follow the process timeline, because if it kind of goes out of order, it can mess up the whole system.
Right. Yeah. Great.
Now, actually, if you want to go back, I don't believe we touched on that, Erica. So if you want to go back 2 more, yeah. This is just a simple thing, but for people who are interested in funding their self-directed IRA, obviously the contribution, that amount of money is obviously limited to what you can do on a year. Obviously, if you're 50 or older, you can do a $7,000 contribution. It could go into either a Roth or a traditional IRA. The transfer is moving the funds from another custodian. So like I said, if you're at E-Trade or Schwab or whomever, and you want to move the money from an IRA to IRA, that would be considered a transfer. A rollover is like something, a 401k, a 403b, a 457, any kind of pension plan, a Kehoe plan, etc. If you want to move money over to us, it would be considered a rollover. You can do it directly or indirectly. The 60-day rule more applies to an indirect rollover. And then the conversion, where you can, you could do an IRA, open up a traditional IRA with us and convert it over to a Roth with us, or you can convert it before it comes over to us. So it could be a traditional IRA at your existing wirehouse and move over to next generation as a Roth IRA. So those are the options for funding a self-directed IRA.
Awesome. Okay, so now that we've covered everything, I don't think we have any questions at the moment, but oh wait, we have a few. Give me 1 second. So Norman would like to know, do you build speculatively or only per a contract with the lessee?
Generally, we're not builders, we're not developers. We're generally buying assets that are existing medical office. They may have a little bit of vacancy, they may need refurbishment, but we're generally buying, at least through Wythe, we're generally buying assets that are existing medical office buildings that have some tenancy in there. That's what we look for. That's our model.
Okay. There's a couple other that aren't very applicable, so I'll save those for you, Peter and Henry, for afterwards.
Sure.
But obviously there's nothing else. So with that being said, we're going to wrap up today. And if anybody has any questions for us or any questions for either Peter or Henry, I don't think that we have contact information for you guys on the screen, but if you guys would like to get in contact with us, this is how you would do that. Obviously the website, and then our new accounts, email address, things like that. So if anything else, that is the end, and we will see you on the next webinar. So thank you everyone for joining, and have a good evening.
Thank you, everybody.
Thank you, gentlemen.
Yep. Thank you.
Have a good day.
All right, bye everyone.